Hi, and welcome to a series of lectures for the Taxation UK F6 examination, as now it is known. And that's the first point to note there, it's UK taxation. So, although there are many variants, of course, around the world, if you're studying for one of those, I'm afraid these are not the lectures for you. We're dealing with UK taxation here. Now, of course, some of you will be from the UK and obviously studying the UK tax paper itself, but some of you will be from overseas. And those of you from overseas may well be studying, therefore, what is to you a foreign taxation system, and possibly indeed in a second or third language. Well, my hearts go out to you, and I have endless admiration indeed for you taking on that particular challenge. But it is what it is, and therefore, if you've chosen to do this, then we've got to deal with it. And what these notes and these lectures are all about is, of course, not to try to turn you into some sort of UK taxation expert. No, they have one basic idea in mind, and that is to give you, of course, sufficient knowledge to be able to pass this examination. That is the criteria that we'll be judged by, our ability to get a pass mark in this examination. Now, taxation is a very challenging subject, and whichever country you may be dealing with, it's always a challenging subject, because not one that necessarily has a great deal of rationale there, not necessarily a great deal of understanding. It's a learning exercise. People make rules for taxation in the UK, in any other country, and different people could create different rules. We have a set of rules created by those responsible for our UK taxation system. Some of those rules you might not like. Some of them you might think, that's silly, I could do better. Well, I'm afraid they are what they are. If you think you could do better, become the Chancellor of the Exchequer and you can change them there. But until then, they are what they are. Now, being rules made up by people, they, of course, don't necessarily have a great deal of logic necessarily behind them. And, of course, they are rules. They are cast in stone. There's no easy way. You have to learn these rules. Now, the object of these lectures is to take you through chapter by chapter, vast majority of the chapters anyway, all of the technical chapters, that is for sure, and explain to you how these rules work and what you need to know to pass the exam. If you glance through the course notes, you will see that they're a lot shorter than you would have from any of the excellent, might I add, ACCA approved texts. We are not in this series of lectures, nor in terms of our course notes, trying to deal with every bit within the syllabus. We're not going to be able to cross the T's and dot the I's. We need to make something that is manageable, that you are comfortable with, and therefore you can use in the examination room to pass the exam. So you will see, when you're using the ACCA approved text, as you must in terms of exam/revision kits there, you will come across certain objective testing questions where indeed the knowledge that lies behind them will not necessarily be within these notes. I'm not going to pretend that anything and everything that could possibly come up in an objective testing question in your exam will be found within these notes. Now, if you wish to therefore support these notes, not just by the acquisition, which is essential, of one of the ACCA approved, as I've just said, exam or revision kits, but with a study manual, then fine. But I would recommend that you would then use that study manual as a reference book, not as a reading book. They are way too big. What I hope we have here within the notes, within the lectures, is, as I've already said, something that is manageable, that will achieve what I suspect is your goal. Not that you're going to take a huge fascination in the UK taxation system, though I hope along the way you might, but indeed what will give you the knowledge to pass the exam. You've got to score 50 marks or more in this exam when you take that exam. That is our clear target. So for the more detailed knowledge, you can acquire an ACCA study manual, and again, they are all good from the approved providers there. But what you will need most definitely is that revision or exam kit, because it is practice, as the old saying goes, that makes perfect. There is practice questions here, examples contained within each chapter and related to each chapter. But that's not enough. You need the extra that the exam kits provide, because again, the ACCA approved providers are able to use the past examination questions updated here for the most recent Finance Act. More of that in a moment. And that will give you the invaluable and the required practice that you need. You cannot walk into this examination without having had that essential practice. So, the ingredients for your success: these course notes, these lectures, and the approved, ACCA approved exam or revision kit. If you wish, if you want to use it as a reference, not a reading book, then a study text, a study manual as well to back that up. Okay, now in that study manual, in these notes, what are we dealing with in terms of the syllabus? Now we're dealing with the taxation of both individuals, which we refer to as personal tax, and also to companies, corporate tax. And as we see here at the beginning of these course notes, in the syllabus section right at the start, what we've got, the idea, the aim to develop knowledge, which of course it principally is at this level. And more recently, what they've tried to do is bring a bit of skills into this as well. Knowledge and skills, more of that later again. Relating to the tax system, as is applicable to individuals, that, as I've said, is personal tax, taxation of the individual, and then companies, whether they be single companies or groups of companies there. So there are two main categories: personal tax and corporate tax. Now, corporate tax does one thing: corporation tax. Companies will pay corporation tax on their worldwide income and gains, their total profits, income and gains. More of that mix again in a moment's time. Individuals have lots of different taxes that they will pay. Now, what taxes do you think we would pay? Well, the main tax, of course, that's paid by individuals is income tax. Most of us, we hope. What are you studying for? You may indeed be fitting this study around your work. We hope, of course, to get a good job. So there will be income from employment. Maybe one day you'll have your own business, and that business might be that of a sole trader, or you might be a partner within a partnership, in which case you will be assessed on a profit that has been made by your business, or if you're a partner in a partnership, your share of that profit made within the business. But you would be running an unincorporated trade. Whether that's sole trader or partnership, it is unincorporated, a term I hope you're familiar with, of course, from your financial accounting studies. Individuals pay income tax on either their employment income or their self-employment income, that being an adjusted, as we call it, trading profit. Companies, on the other hand, will pay corporation tax upon their income and their gains. Notice there the term gains, because when we look at personal taxation, as we'll see as we go through this introduction and these notes, there are various taxes upon the person. And that's what these objectives give us. If I skip to the second point here, we get the first and the probably biggest tax within our syllabus, and that is income tax. We have to be able to explain and mostly compute income tax liabilities of individuals. But when we're looking at income tax, as we've said, the main source of such income is likely to be, for the majority of taxpayers, that which they get from their employment, if they're an employee, or from their business if they are self-employed there. But in relation to such work, employment or self-employment, there's another tax. Now, those of you who live and work within the UK will be very familiar with this. It's known as national insurance. And we make national insurance contributions, or NICs as we'll know them from now on, national insurance contributions. Now that will be a new term, certainly to those of you from overseas. It's just another form of taxation, but one that is very specifically applicable to either employment income or your trading profit assessed on the self-employed. So it's very specific to earned income, be it employment or be it self-employment, but specific to earned income. It does not apply to any other income. Who pays that? As we've just said, employees and the self-employed. But if you are an employee, then it's not just you, the individual, that suffers the cost of a national insurance contribution. There's also your employer. Indeed, for the privilege of employing you, they get not just to pay you, but they also get to pay over to Her Majesty's Revenue and Customs, HMRC, as we will now know them as for the future. They get to pay over employers' national insurance contributions as well. But just think of it as another tax that relates to your income, specifically employment or self-employment, whereas income tax will relate to all sources of income that are taxable, and that includes not just employment and self-employment, but other sources of investment income. Now you think, what sources of investment income might you have? If you're lucky enough to have, of course, investments there. Well, you might have money in the bank or another financial institution, and that pays interest. Interest income. Most interest income is taxable. Certain examples of it, as you'll see in Chapter 2 when we look at the detail of it, are actually exempt, but most of it is taxable. You might own shares in companies, and on those shares, hopefully, the company does well, it pays a dividend to you, the shareholder. So you could have dividend income. And if you're doing really well, you might not just have your own property in which you live, but you might have a second or third property that you let out there and from which you gain property income. All of these are involved within our income tax. If we have income other than the relatively few sources of exempt income, they're going to be chargeable to income tax, and that will require an income tax computation to be prepared. So this first section that we deal with, income tax, and in relation to earned income, employment income, or the trading profit of the self-employed, the unincorporated trader, we have these national insurance contributions. And as I've just said, paid by employees, employers, and the self-employed. Income tax, as I've just intimated, is probably the major tax within our syllabus and will probably have the majority of the marks compared to any other tax that is. Next on that list, in terms of importance for us in the exam, is corporate tax. Now, as it's set up here, we've got to deal with both single companies and potentially also companies that exist within a group. Now, again, don't worry about groups of companies in the context of what you're probably familiar with from financial accounting, your financial reporting there. If you've done that, as I hope you would have done by now, financial accounting, you'll be aware that if you have a group of companies, there's consolidation. We prepare consolidated accounts. Well, don't worry, we don't have any such thing as a consolidated group corporate tax computation. Each company will be required to prepare and submit its own corporation tax return. But if you exist within a group of companies, then there are certain special rules that apply to you, but also certain opportunities as well. There's various claims that may be made that may mitigate the overall tax burden of the group of companies as a whole. So we got corporate tax. And as we'll see on this point here, again, explain and compute corporation tax liabilities, individual companies, and groups of companies there. Now, you may recall a few minutes ago in terms of this introduction, we said as well as personal taxation, corporate taxation on companies, and companies would pay corporate tax on their worldwide income and gains, capital gains. Now, it's a simple concept that either an individual or a company might buy an asset and at a later point in time be able to sell that asset for more than they paid for it. There is your basis of computing a chargeable gain. That's the simple concept. You sell an asset for more than you paid for it. Now, individuals have a separate taxation to deal with that. It's called capital gains tax, or CGT, as we will know it. And that one is referred to here. Compute the chargeable gains arising on individuals equals capital gains tax, CGT. But companies don't pay capital gains tax. Companies, as we'll discover, and as we keep on saying, pay corporation tax on their worldwide income and gains. They pay tax on what is called their taxable total profit. And profits are made up principally, of course, where do you think most of a company's profit would come from? What does it do? It trades. So the big one, of course, is trading income. But a company too might have other sources of income, a property that it doesn't use in its trade and it's able to let out. Got property income. It may have interest income. You might also think that it has dividend income, and well, it may. But a rule, as we'll learn when we look at corporation tax in Chapter 15, a long way off now, of course, for you, but dividend income is not charged to corporation tax. When a company pays a dividend to another company, the payment of the dividend does not reduce its profits chargeable to tax, and it does not therefore represent a source of taxable income in the hands of the recipient company. So companies will have trading income, they'll have property income, they may have interest income, and they may also have chargeable gains. If they've been able to sell assets at a profit, made a gain thereon, then subject, of course, to the detailed method of calculation of that gain, it will be included within their corporate tax computation. So companies, corporation tax. Now, it's not the only tax that they have to deal with. They will have to administer the income tax system for their employees, because employees will have tax deducted at source from their salary or wage each week, each month there. Who does it? The employer. Usually that's a company. So they're responsible for the collection of tax. Something called the pay-as-you-earn system that is applicable so far as employees and employers are concerned. That the employers have to administer that system. They are doing the dirty work of Her Majesty's Revenue and Customs for them, collecting income tax and indeed national insurance contributions at source and paying that over to HMRC. So companies will pay corporation tax on their profits. They'll have to administer the pay-as-you-earn system, deducting tax and national insurance contributions from their employees. And as a trading entity, they'll have sales, they'll have purchases and expenses, hopefully less than the sales, and that will give rise, we trust, to profits. But on those sales and purchasing activities, there's going to be another tax. And that one down at the end here is value-added tax, VAT. Again, if you are not within the EU, pretty much as we won't be in the EU fairly soon, but if you are not aware of value-added tax, the idea is like a sales tax there. A tax made on the sales made by a VAT-registered business. So it's a sales tax. And again, the companies, businesses, will have to administer that tax. Now, as we've said, not all businesses are in the form of companies. Also, there are unincorporated trades. So individuals who have a sole trade business or operate a partnership, those businesses will also have to deal here with this one, VAT. Go back, though, to what we said about capital gains. Companies will pay corporation tax on their overall gains, income and gains there. Individuals will actually pay CGT. And then there's a further tax that we need to understand. There's an old saying, isn't there, that you can't take it with you when you go, i.e. when you die there, that you can't take it with you when you go. One of the reasons for that is we have inheritance tax there. Yeah, from the moment you're born, you exist independently in terms of the UK taxation system. If you individually have income, then that will be going to an income tax computation. If you make capital gains, that will go to a capital gains tax computation. And then, when you die, they have inheritance tax. What we'll discover is that inheritance tax computations may be required, not just for the one obvious point in time where if you're going to have this tax, it's going to be charged then at the death of the taxpayer. But if you really want to, You can indeed make sure that you pay IHT while you're still alive. I'm sure we'll all be queuing up to do that. There are certain transfers that can be made in lifetime. This waits us right up towards the very end of our studies of this subject of ours. But there are lifetime transfers that are chargeable when made, as well as being chargeable on death. But inheritance tax, we're basically dealing with the death of the individual, and when those assets are passed from one generation to another, when it's left to the kids or the grandchildren, there will be chargeability to IHT. How much, if any, dependent on the amount of that estate. We talk about that, however, towards the end of our studies. So there's a whole raft of personal taxes. The main one, income tax. Again, the most tested subject within this particular paper. Little bit about national insurance contributions. Again, you'll probably see either in section A, the odd objective testing question there. I'm sure we're familiar by now with the objective testing system. Or you might have as a part of a section B question possibly. Not so as likely within section C unless it's an add-on to an income tax problem, but more about the content of those sections and the way in which each of the taxes will be tested later. So in relation to our taxes on the individual, we've got our income tax, we've got national insurance, we've got capital gains, we've got inheritance tax, all relating to the individual. Corporation tax, of course, on the taxation of the profits made by a company. Those are the areas covered, apart from the bit that I missed out at the start there, explaining the operation and scope of the tax system. That is rather more to deal with admin, the administration system. Now, in Chapter 1 of these notes, there's an introduction to the tax system, and then admin is dealt with from personal tax point of view in Chapter 15, and for companies in Chapter 23. Those chapters are basically self-study. They're in Chapter 1, don't worry about that at the beginning of your studies. It's background, but it's not the sort of stuff that comes up regularly in terms of exam questions. My advice to you, although it's Chapter 1, is to actually leave that to the end. If you want to do a little bit of reading as an intro, fine. But most of that is not the stuff that gets specifically tested in terms of exam questions. And because it's all narrative based, it's the sort of thing that you probably don't want to be trying to learn that right at the beginning of your studies. What you want to be focused on is the doing exercises, the computations that you're going to have to prepare, the calculations you're going to have to perform. That's what you need to be focused on, getting used to the concepts, practicing, doing those calculations, preparing those computations. Once you've got a mastery of that, then by all means go back and look at the more general nature of the tax system and also indeed the administration of those tax systems. There will be admin questions just about for sure on that paper. Again, one or two in section A or potentially parts of a section C question. They could come up anywhere effectively there. But get the core areas studied first. Do the doing things. Get that core knowledge. And then we can worry about the bits of admin. All right. Now, those taxes that I've just talked about are then dealt with within the detailed syllabus. That's where we look at each of those taxes in turn. And of course, on there, the UK tax system and its administration. Again, as I said, you'll be reviewing through that for yourself. But these main areas, income tax and national insurance contribution, we already know about this. In terms of the scope of income tax, income from employment. You're an employee, you have a salary or a wage. Clearly, employment income is going to be chargeable to income tax. Not only will that income, of course, be chargeable to income tax, but we'll also have national insurance contributions for the employed. So on employment income, income tax and national insurance contributions. Income, of course, for those who work may be having worked for somebody else to begin with. You think, I'm going to work for myself from now on, and therefore self-employment. If it's just you, you're a sole trader. If it's you and some colleagues, then a partnership may ensue. But there will be income from self-employment. And of course, as it's earned income, then the self-employed will also be chargeable to national insurance contributions. Now, those are essentially straightforward basic calculations. Now, of course, there are different rates for the different taxes, different allowances, different limits that apply. Don't worry about that. That's not a learning exercise, because you have available to you in the exam room tax rates and allowances pages. A lot of stuff that would otherwise be a real problem trying to learn, you don't have to. It's provided to you. And you see that just a little bit further on in these notes, there's a rates and allowances section showing you what will be made available to you in your examination. So, for those of us, most of us, of course, of working age, we either have employment income or profits from self-employment. But of course, there may then be forms of investment income. Now, we refer to property income as well as other forms of investment income. Other forms of investment income, as we mentioned, interest income, dividend income for the individual. Our problem in terms of all these different sources of income is collecting them together in relation to a given time period, so that for that time period we can then compute the income tax liability and the income tax payable by the individual. What we'll discover here is on this computation of taxable income, we will prepare an income tax computation for a given time period. It's known as a tax year. I'm not going to worry about the dates of that just at the moment, but as you'll discover, it's rather peculiar dates as compared to a calendar year. We have a specific tax year. To that tax year, we will relate all the different sources of income. Now, of course, income arises in different ways. I've got a job, I'm paid weekly. I've got a job, I'm paid monthly. I'm self-employed. There are trading profits made for an accounting year. Dividend income comes in whenever the dividends are paid by the company. The interest income comes in whenever the bank or other financial institution pays that. So what we have, and we'll look at this through the opening chapters on income tax, are bases of assessment by which HMRC say to us, the individual, you will prepare an income tax computation for a tax year. This is the year in question. And here are the rules that you will apply to include the relevant amount of income to be assessed for that tax year. And we'll put it all together on an income tax computation to firstly compute our taxable income figure. And like with all computations, whether it's income tax, whether it is corporation tax, capital gains tax, inheritance tax, or indeed national insurance contributions, the first thing you've got to do is to establish the amount that is taxable. But having got the amount that is taxable, you can then progress to the second stage, computing the tax thereon. And that's a common theme in relation to all of the tax computations that we'll have to do throughout our studies. Let's find out first of all what is taxable, and then how do we calculate the tax thereon. We do it for each of those taxes. So in relation to the big one, income tax and NIC liabilities there, what we've got, all the different sources of income that are taxable. There's a few exempt sources, but very few, so far as our syllabus is concerned anyway. Very few in reality, to be fair, as well. And if you've got earned income, then it's not just income tax, there's national insurance contributions as well. Corporation tax. Companies pay corporation tax on their worldwide income and gains, a figure known as taxable total profit. You may recall I mentioned that again a few minutes back. So we calculate taxable total profits. That will include any chargeable gains made by companies, as well as all of their taxable income. So far as companies are concerned and taxable income, most of it, if not all of it, will come from their trading activities, trading income there. They may have property income, they may have investment income. What they won't be taxable on, as we said earlier, is dividend income. Whereas individuals like you or I, we are chargeable to tax upon our dividend income. How much, if any, tax we pay, well, that's another matter. That's the tax calculation itself. We've got to, of course, having got the taxable total profit, then compute the corporation tax liability. That's a pretty simple exercise these days because having got the TTP, there are tax rates, single tax rates set for what for companies are said to be financial years. So the worst thing that can happen is that we may have to time apportion what is a chargeable accounting period of a company, the period for which the corporate tax computation is prepared. We may have to split it into the 2 financial years which it spans. It will never be more than 2. It's possible, and it's very often the case, that the accounting period falls entirely within 1 financial year, and therefore only 1 rate of tax. With income tax, it's rather more problematical because there's many more different tax rates depending on how much income you have. As the income gets higher, the tax rates get higher with it on a progressive basis. Your first bit of income 1 rate, the next bit of income a higher rate, and we go additional rate on top of that. So there are different tax rates there applicable. With companies, it doesn't matter what size the profit is, how big it is, there will be a tax rate that is applicable to it. The only question is, do we span 2 financial years when for those years there were 2 different tax rates? But the calculation of tax for companies, corporate tax, a whole lot easier, as you'll discover, than income tax. We also said not just single companies, but groups as well. Again, what we'll discover there is 2 things. For groups, there are certain rules that say, if you do this, this is the way that you do it. There's no choice, it is a rule that we must have to learn. And also then for companies, in a group, there are certain claims or elections. Now, if a claim or election is available to a taxpayer, think about that. This is action that the taxpayer can take. You'd only take that action if for you, whether personal, an individual or a company, if for you it had a favourable effect. So we have to know what those claims and elections are for individuals, for companies, and here, as we're talking about it, for companies within a group. So we need to understand the nature of that claim. What does it do? Just because it's there doesn't mean to say that it will be beneficial. We would only exercise that claim, that election, if it were beneficial. So we've got to be able to evaluate the outcomes. What would happen if I don't make the claim? What would happen if I do make the claim? If I'm better off with the claim, then I will make it. If not, I won't make it. And you'll see in relation to each of the taxes, there are various claims, elections that may be made, which will only be made if a benefit to the taxpayer, whether here, corporate, or indeed, as you'll see, personal as well. The use of exemptions and reliefs in deferring and minimising corporation tax liabilities. Yeah, reliefs there, we said about group corporate structures. Again, there are reliefs that can be claimed that are specific to groups rather than just to individual companies there. But again, we need to know what they are, how they improve your tax position, and be able to quantify that to know whether they are beneficial. What we have, and this is certainly an area where it is notable, is a situation where you may be aware that at the foundation level at F6, the Tax UK, we have our first taxation paper. But when you get through to the professional level and the P examinations there's P6, Advanced Taxation. Now these 2 subjects are very different. Here it's about learning the rules and applying those rules to compute tax liabilities of individuals, whichever tax that might be, and for companies, corporate tax. When you get to advanced taxation, it is about applying skills rather than just regurgitating knowledge. Now, what had happened up until a few years ago is that these two exams have become almost polarised. They were very, very different. And ACCA appreciated that students had done F6, learnt the rules, regurgitated the rules, passed the exam, and came to P6 Advanced Tax, where it was much more an applicational, a skills-based paper, and struggled with it. Some of the pass rates at P6 Advanced Tax internationally are very, very low indeed. So what they've quite rightly done is to try to, though you might not think so at this point in your studies, is to beef up the F6 Taxation UK F6 paper and bring more skills into that. And here is one area where skills come into play. The ability to understand that in this situation, there's a claim, there's an election that is available to the taxpayer. It is one thing to know that it is available, that to begin with scores you marks on an exam answer, but then you've got to quantify the effect of that claim, that election. Obviously without and with, and if with, it is a lower figure of tax, then that is the benefit, that is the claim that you would make. What we'll discover is that some of the reliefs that are available, the claims that may be made, would reduce, would minimise the corporate tax liability. Others, mostly to do with capital gains, would defer. So they won't minimise, reduce the liability of this accounting period and forever, it's gone. But they will say, okay, in this situation, you won't have to pay the tax, and it's usually on a gain for this accounting period, will allow you to defer it. So two types of relief here. Those that allow you to reduce absolutely an amount of profit that would otherwise have been chargeable. You get it now and you get it for good. Or secondly, the deferral type of relief, where there is something to be charged to tax, but okay, it wouldn't necessarily be, I'm going to use the F word here, fair. It wouldn't necessarily be fair to tax it now, in which case, therefore, you are allowed to defer that. So you don't have to pay it now, but at some future point, something will happen to crystallise that deferred gain. So we get an element of skills coming in. When we look at the structure of the exam, just a little later, I'll tell you where we're probably going to see that skills-based question coming through. And chapter 26 in these notes deals specifically with that type of tax planning question. But again, more of that later. Chargeable gains, the taxation, of course, of gains. We've got to learn the basic principles of how we compute a gain there. We've got to be able to deal with this for both personal tax, individuals, and also there are certain special rules that apply for companies. Now, for an individual, it's a fairly basic and obvious idea. I buy an asset that is deemed to be a chargeable asset. I buy it for £20,000. And some years later, I'm lucky enough to sell it for £30,000. Sold for 30, bought for 20. I've made a gain of £10,000. That gain then may be subject to capital gains tax. So the concept is a simple one. But of course, like all of the taxes, there are lots of different rules dealing with all the different circumstances that might happen in practice and the types of asset that may be sold. Gains and losses may arise. Just because I own a chargeable asset, I bought it for £20,000, doesn't guarantee that when I do sell it, I'll sell it at a profit, like the £30,000 a moment ago. I might buy for £20,000 and oops, some years later, I sell it for £15,000. I've made a loss of £5,000. So we've got to be able to compute, where appropriate, both gains and losses there. Here on the disposal of movable and immovable property. Movable and immovable. Yeah, different categories. The movable, we tend to have, here's a lovely name, we refer to as chattels. There's a lovely term, chattels there. Tangible, movable property. And depending on what type it is, again, as you might guess, there's a separate set of special rules that apply. sort of chattels that you'd see, possessions like a painting, an item of jewellery there, an antique, movable items. Whereas immovable property, a house there, would be your typical example. So we're going to be able to deal with both. And also very specifically mentioned and almost certain to be tested in every examination, now given the structure of the exam system with the objective testing questions, the disposal of shares and securities. Again, at least we'd expect to see within section A of our paper, the objective testing section, at least one question there on, if not indeed involved within a CGT question, which is probably going to be within section B, but that discussion comes later there. Having got the amount of taxable gain, then we can calculate the capital gains tax thereon. And as we spoke about with corporate tax a moment ago, the use of exemptions and reliefs in deferring and minimising tax liabilities arising on the disposal of capital assets. So capital gains tax will relate to individuals, companies will pay corporation tax. How we calculate gains, specifically gains, for individuals differs slightly to the way in which we calculate it for companies. But again, the detail of that awaits us in the detailed chapters. Individuals, of course, may set up businesses either in unincorporated or incorporated form. And if we're dealing with a business, then value-added tax, that sales tax, comes into play. And what we've then got to look at is which businesses. Do all businesses have to deal with the VAT system? Do they all have to account for VAT? What are, therefore, the registration requirements? It's a size thing there in terms of the amount of sales that they make. And if they do have to register, or as we'll discover, if they choose to register for VAT, then how to calculate any VAT liabilities that the business has that then needs to be paid over to our old friends HMRC there. There are also various special schemes which mostly deal with smaller businesses to help smaller businesses administer the system for one, and indeed to hopefully avoid cash flow problems that might otherwise arise from the operation of the VAT system. But again, all of that awaits us in VAT in one of the chapters at the end of our studies. Come back to the last then of the personal taxes, inheritance tax. Now, what we said was that the usual circumstance that we're dealing with is the sad demise, the death of an individual. So the liabilities arising on chargeable lifetime transfers and on the death of an individual. Now, for the vast majority of taxpayers, the only time they will be involved in terms of inheritance tax is on the occasion of their death. Or, of course, the individual may be a beneficiary, but then somebody else has died and they are receiving a part of that estate. So it's normally the death of an individual. But as I said to you, there are certain things, chargeable lifetime transfers, that if made, the name is a giveaway, in lifetime, then they are chargeable. We don't wait around to see if you die. They are chargeable there and then. We've got to, in calculating what is chargeable to tax, understand a concept known as transfer of value. Now is not the time for that. But that's the basis of dealing with chargeability. And again, not that there's very much of this in relation to our syllabus at this level. Much more of this awaits at P6 should you choose to go down that route. There's the use of exemptions and deferrals to minimise your inheritance tax liability. And of course, as soon as you know what is chargeable to tax, what's the second bit? The calculation of the tax and the payment of that taxation, therefore. So, we have a syllabus stuffed full of taxes. Most of them are personal taxes, i.e. on the individual. The obvious one, income tax. That covers all sources of taxable income. But in relation to one particular type of taxable income, employment or self-employment, then there are national insurance contributions that will have to be paid thereon as well. What are the taxes on the individual? You buy an asset, some years later you sell that asset and you make a gain. Depending on how much gain you make, there may be capital gains tax to pay. Eventually, sad to say, we die, and at that point what we leave to our beneficiaries, I'm specifically thinking about here when it goes to the kids, the grandchildren, transfers to one generation to another there, then there will be chargeability to inheritance tax. Now, when somebody dies, their estate isn't necessarily all chargeable to inheritance tax. For example, transfers between spouses are exempt. So, when I die, all of my estate will go where? Not to my kids, but to my wife. Why? Because she told me so. So my estate, therefore, will go to her. And when that transfer happens, there'll be no inheritance tax. I can die happy. Isn't that good news? No IHT. But of course, when she dies, which of course will happen probably soon thereafter. I mean, could she live without me? Don't answer that. So when she dies, where does it then go? It goes down to the kids. But at that point, it hits the proverbial inheritance tax fan, where we'll discover that to begin with, very good news, there's a nil rate of tax. Oh, if only all rates of tax could be nil. But thereafter, there's a bit of a change. It goes from nil rate up to a certain level of transfer to then 40%. There's no messing about in between here, nil and then 40%. 40% is a very large figure. And when you go through rather more to P6, but a little bit at this level, clearly this is a tax that all of us are going to encounter. All of us, I've got some very bad news for you here, we're all going to die. Obviously, some of us this side of the camera rather sooner than you, that side of the camera there, no doubt. But we're all going to die. And when we do, inheritance tax is going to have to be paid. So, on that basis, if a part of your estate above a level of the nil rate band is going to suffer 40%, well, you would try to take action to mitigate the effect of that tax for when you do die. And again in chapter 26 we cover that particular point. So what could you do to hopefully minimise the chargeability to IHT? Something that gets picked up on and dealt with in way more detail and way more interesting detail at P6. We've got a bit of that at this particular level. So we've got our personal taxes, income tax, national insurance contributions there if you're employed or self-employed, capital gains tax, inheritance tax. Companies, corporate tax, whether it's income or gains, that's what companies pay corporate tax on. And if you're in business, you've got to deal with the VAT system. What we'll discover in the next bit of our introduction, we'll take a break at this stage, is where do those particular areas and how do those particular areas get tested within the examination itself. We'll look at the structure of the exam. Probably by now a pretty familiar structure in terms of exams that you've already done, of course, prior to taking this F6, this Taxation UK exam. But I'll briefly run you through that next time. I look forward to seeing you then.
This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.